You've probably heard the stories. Billionaires with lavish lifestyles who somehow pay little to no income tax. Well, it's not magic and it's not illegal. It's a very real three-step financial strategy. And today, we're going to break down exactly how it works. So let's just get right to the big question. How on earth do you live like a billionaire? We're talking yachts, private jets, the whole nine yards, while legally paying next to nothing in income tax. It sounds totally made up, but it's not. It's a reality for a select few, all thanks to the way our tax system is structured. To really get this, you have to understand one core concept. There are basically two different financial rule books in our tax system. There's one for people who earn money from a job, and a completely different one for people who own things that make them money. Okay, so rulebook 1 is for earned income. That's the salary most of us live on. The second that paycheck hits your account, boom, taxes are taken out. But rulebook 2, that's for appreciating assets, stuff like stocks, real estate. Their value can skyrocket by millions, but none of that growth gets taxed as long as you don't sell. I mean, just look at this difference. Your paycheck could get hit with tax rates over 40%, but the growth on your assets, that's what they call an unrealized gain, is taxed at a nice, clean 0%. As long as you just hold on and don't sell, that wealth just keeps on growing, completely tax-free. And that massive gap between how we tax work and how we tax wealth, well, that's the loophole that makes this whole powerful strategy possible. It's famously known as buy, borrow, die. Let's dig into step 1. All right, step 1 is the foundation for everything. Buy. This is all about scooping up assets that you expect to become more valuable over time. So, what's an appreciating asset? It's just a fancy term for anything you own that's likely to go up in value. We're talking stock portfolios, commercial real estate, maybe even a Picasso. The game is simple. Own things that will be worth more tomorrow than they are today. And this right here is the absolute key. Let's say you buy $1 million of stock and it balloons to $10 million. That $9 million profit you just made, it's called an unrealized gain. And as long as you don't touch it, don't sell a single share, you owe exactly 0 tax on that $9 million bucks. Okay, now for the really slick part, step 2, borrow. This is how all that on-paper wealth gets turned into actual, spendable, tax-free cash. So here's the puzzle, right? Your net worth is through the roof, but you can't exactly swipe your stock portfolio at the grocery store. And if you sell to get cash, you get hammered with a huge tax bill. So how do you get your hands on that money? The answer is a simple financial tool that you've definitely heard of, collateral. It's just something valuable that you promise to a lender to back up a loan. And here is the genius move. Instead of selling your assets, you walk into a bank and say, hey, see my $10 million portfolio? I'd like to use that as collateral for a loan. Because that loan is so secure, the bank is thrilled to give you a multi-million-dollar loan at a super low interest rate. Now listen up, because this is the magic trick of the whole strategy. The cash you get from a loan isn't considered income by the IRS. It's debt, and you do not pay income tax on debt. So what's the tax bill on those millions in cash you just got from the bank? A big, fat 0. You can go out and spend that money on whatever you want, all while your assets are hopefully still growing in the background, making you more money than you're paying in interest. Which brings us to the final and, let's be honest, the most morbidly fascinating part of the strategy, die. This is the step that locks in all the gains and deals with that massive loan you took out. Okay, I know what you're thinking. Wait a minute, what about that huge loan? Somebody has to pay that back, right? And what about all those untaxed gains? Yes, they do have to be dealt with. And this is where the final, unbelievable piece of the puzzle clicks into place. The answer is a wild little rule in the tax code called the stepped-up basis. When you die and pass your assets to your heirs, the tax system essentially hits a giant reset button. The original cost of the asset is stepped up to whatever its market value is on your date of death. So remember that stock portfolio, bought for $1 million, now worth $10 million? Your heirs inherit it with a brand new cost basis of $10 million. They can then immediately sell, say $2 million worth to pay back your loan, and since their cost basis is the same as the sale price, they owe almost nothing in capital gains tax. That original $9 million gain, poof, wiped away for tax purposes forever. So we've walked through all 3 steps. Let's just take a quick step back and look at the whole cycle one more time.
And there it is, the whole playbook. You buy assets that grow, you borrow against that growth to get tax-free cash, then you die, and the stepped-up basis wipes the tax slate clean for your heirs, who can then pay off the loans and start the whole cycle over again.
And that brings us right back to where we started. It's a completely legal strategy that allows some of the wealthiest people to live like kings while paying almost no income tax on the wealth that funds their lifestyle. So, why does this all matter? Well, because it throws a giant spotlight on those two rule books we talked about at the beginning. It shows, in the clearest way possible, how differently our tax system treats money you earn from a hard day's work versus wealth that you gain from just owning things. Which really leaves us with one big final question. Is this buy, borrow, die strategy a clever feature of our system designed to encourage long-term investment? Or is it a massive flaw that allows incredible fortunes to pass from one generation to the next almost entirely untaxed? That's a debate that's still raging.